Good afternoon and welcome to Cherry Bekart's webinar. I'm Jamie Walker, a leader in the Cherry Bekart's professional services practice. I'm a tax partner in Richmond, Virginia. Joining me today is Marty Caramon, a principal of Cherry Bekart's Strategic Tax Advisory Services. Marty is a leader of the firm's credits and accounting methods practice, and he also heads up our ERC or Employee Retention Credit team. Ann Yancey, director of Cherry Bekart's States Credit and Incentive Services, and is also a member of the ERC team. Third, Deb Walker, Director of Tax Services at Cherry Bekaert. Deb is also a member of the ERC team. Our topic is the Employee Retention Credit. The ERC continues to offer substantial refundable tax credits to a wide variety of employers. This webinar explains the process of calculating, securing, and maximizing the ERC. Today, our presenters will share the lessons they have learned by helping hundreds of companies benefit from this payroll tax benefit. Let's get started.
Jamie, thank you. And everybody, this is Marty Caramon. I appreciate everybody who took the time to join and talk to our team. We wanted to have this webinar today for a few reasons. One is it's called Lessons Learned because there have been a number of them learned, but it's really helpful to talk to whomever may want to listen to this after we've had the opportunity to have 600 or 700 different client discussions and fact patterns since January, since the rules shifted dramatically. There's a lot of insight that we've gained over that time, and as a result, we're going to talk about some basics and maybe some advanced materials as well in terms of what some of the nuances are around the credit and what some interesting issues that we've seen come up are. As we go through this, we are going to talk about the ERC from beginning to end when it was issued last March and how it evolved over time. We'll then go through some of the basics about what it takes to be an eligible employer. Additionally, the definition of gross receipts, some of the control group analysis issues that we've seen come up, what it means to pay qualified wages, and how you do your employee counts, both on an individual basis and potentially in a control group basis as well. We'll get, hopefully, I think more interesting after that, after we go through some of the basics around what we call myths and misconceptions, which sounds like a Jeopardy category, but it really is an discussion of what we refer to as like hot topics or topics of high interest. And we're trying to jump ahead of some of the questions that we know you're going to want to ask, and some of them that we've already seen come through as well. We're going to talk a bit about the interplay of PPP and ERC, how to claim the ERC, what we're seeing with respect to refunds, the timing on refunds, how you claim refunds, and what it means to have a successful project as well around ERC, and what the data basics are that we would need to scope it, or you would need to scope it as well. And so with that, why don't we get into it? All right. So the first slide here is wordy, but it's intentionally wordy as a takeaway. ERC from CARES Act to today. The Employee Retention Credit was made part of the law. I believe it was March 27th last year, effective as of March 13th. And to the extent a company or organization qualified for the Employee Retention Credit, but also took a PPP or took advantage of the PPP program, they were statutorily prohibited from taking a look at ERC at all. It was one or the other for all of last year, up until December 27th, when the law changed as part of the Consolidated Appropriations Act, and Congress then allowed companies, even if they gotten PPP, to take a look back and see whether or not they were eligible employer or not for purposes of the Employee Retention Credit. That opened up the program to so many companies and organizations at that point. Additionally, it was extended into the first 2 quarters of 2021 with an even higher credit rate and some more liberal rules to qualify. And then later in March, it was again extended into the second 2 quarters of 2021. As we think about the Employee Retention Credit, the way I like to think about it, and I explain it to my clients, is it's not one credit, it's 5 credits. There's one credit in 2020 that is reported over the course of 3 different forms 941. And that would have to be filed at this point on an amended form 941X as it accrues over time. And we'll get into the rules there. And then there's 1 credit for each quarter of 2021 that is actually more generous than the entire credit for all of 2020, and easier to qualify for as well. Biggest myth and misconception, jumping ahead, is that if you got PPP, yes, you can still claim the ERC, and we'll talk a bit about the interplay there. Yeah, and let's get into it here. This is great. This is summarizing what I had before with a little extra, indicating that for 2020, there is 1 employee retention credit, and for 2021, there are 4 more, 1 for each quarter of 2021. These are payroll tax refunds. For most companies, these credits are intended to be larger than the payroll tax paid by any company during the time they qualify. As a result, these are refundable credits. The amount paid back is well in excess of what they would have paid for payroll tax. This is a stimulus program, really, for most companies through operation of the payroll tax system. For the 2020 credit, you can get a credit on wages paid between March 13th and the end of the year to the extent you qualify as an eligible employer, and we'll talk about what that means. For the 2021 credit, you can get a credit on the wages paid to employees for each quarter of 2021, as long as you are an eligible employer under one of the 2 tests that we're going to talk about. That's a gross receipts test, or what we refer to as the government mandate test. The credit itself for 2020 is basically a 50 cents on the dollar credit for the first $10,000 paid to any one employee after you qualify. The credit for 2021 is a 70 cents on the dollar credit for the first 10,000 paid to any one employee in each quarter of 2021, to the extent you are an eligible employer. The rules I'm stating here are what we would refer to as the rules for small employers, meaning those companies that respectively for the 2020 and the 2021 credits had fewer than 100 full-time employees or fewer than 500 full-time employees in the 2019 calendar year. There are separate rules for companies that are larger that only allow amounts paid to individuals who are not providing services, meaning a company kept someone on the payroll as opposed to having them be furloughed or go on to unemployment. That's actually the subsidy. It's a true retention credit for large companies. Most of the clients we're working with are what we refer to as smaller companies, either 100 or fewer or 500 or fewer full-time employees. With that said, maximum credit for 2020 is $5,000 per employee. Maximum credit for 2021 is as high as $28,000 per employee. So a very, very lucrative benefit. All right, I'll get into this and then I'll pass it on to some of my colleagues to actually talk for a moment. But what we are focused on in identifying companies that can become eligible employers for purposes of this credit are those that have been harmed by COVID in one of 2 ways. They either have suffered a significant decline in their gross receipts in any quarter of 2020 as compared to 2019, or any quarter of 2021 as compared to 2019. The 2020 gross receipts test requires a decline of more than 50% of a company's gross receipts. Again, that's a quarter compared to the same quarter in the prior year, in the 2019 year. For 2021, a company only has to suffer a greater than 20% decline in its gross receipts in any quarter of 2020 compared to the same quarter of 2019. That's the gross receipts test. And we're going to talk about that in a little bit more detail. But again, that's where a lot of companies are focused in terms of, and maybe sometimes they also end the analysis there. There's also a separate government mandate test that even if a company didn't satisfy these gross receipts tests, to the extent a company was disrupted or partially shut down due to government orders limiting commerce, travel, group meetings specific to COVID-19. Essentially, if there were a government order limiting what a company could do directly in terms of capacity limitations, potential work from home, potential travel restrictions, anything limiting commerce, travel, group meetings issued by any government, there's a potential to qualify that way as well, to the extent that government order is then shown to have more than a nominal impact on the business. So it's an either or test. That's one area of confusion. Some companies think you have to hit both. You either need to define a decline in your gross receipts or show that a government mandate was affecting your business. We do see the government mandates being more applicable to companies in 2020 than they are in 2021 due to the fact that over time mandates have been lifted. But if you look at the restaurant industry, you certainly saw government mandates still imposed through 2021. Certain industries where there's foreign travel restrictions and that's a requirement of the business, we've seen that cause a company to suffer what we refer to as a partial shutdown here as well. And we can talk about more examples if anybody has any questions. I will let one of my colleagues jump in if there's anything they want to add, and then we'll get to some more slides.
Marty, let me add just a couple more eligible employers that were added recently under the latest IRS notice number 2021-49. These are probably two categories that are lesser known situations, but just to mention them. One is a recovery startup business is also now eligible for the ERC only for the third and the fourth quarter, and that is a business that began operations after February 15th of 2020, and that company had to have less than $1 million of gross receipts. So if you fall in that category, you're also eligible. And the second group is what's called a severely financially distressed employer. And so the gross receipts test that Marty mentioned for 2021, normally a company only needs to have a 20% drop in gross receipts. If you're severely financially distressed, if you have a drop in gross receipts compared to 19 of at least 90%, so you're really hurt and your gross receipts are 10% or less than what they were in 2019. So just two more categories that are added. And again, that's only for third and fourth quarter of 2021.
Those are really good points. And I will add one more in terms of something that comes up sometimes is I'll work with some companies that might not have a history of gross receipts in 2019. The rules actually for purposes of the 2021 credit allow you to substitute in 2020 for 2019 to the extent there's no gross receipts history in 2019. Similarly, irrespective of a gross receipts decline, if they don't have a history or they can't show a gross receipts decline and they're starting up in 2020, the government mandate test still applies as well in any quarter. Great.
Gross receipts is determined based on your method of accounting, and that's both for taxable and tax-exempt entities. This is an important calculation if you can't use the government mandate, and it's a binary calculation. You're either below the 20% or above, and the same thing for the 50%. So it is important to understand what needs to be included. It's dividends, interest, rents. We do all of this on a controlled group basis. So you have to add together all companies, which are in what's called the aggregation group for this. And generally it's what you own more than 50% of. We'll talk about that later on. The unfair thing I think that happens for tax exempt entities is they often have a lot of investment sales and reinvestment. You have to look at the proceeds, not the gain or loss on an investment, a capital asset when it's sold. You don't get to reduce it. And we did have a question about ERC. ERC is not part of gross receipts. PPP loans are not part of gross receipts, but generally gross receipts is everything that you receive determined on a control group basis. Which brings us to qualified wages, I think.
Okay, so in looking at, in order to determine what your qualified wages are for the ERC, you have to look at how many full-time employees that you have. And on the next slide, we'll define full-time employees, but just to add that here, full-time employees, you're going to be looking at your 2019 monthly average of employees, and full-time is defined as an employee that works 30 hours or more per week or 130 hours per month. And so once you're able to determine your full-time count on a monthly basis, divide that by 12 and come up with your average annual full-time head count, then you look at the rules for 2020 and 2021 that's on the screen here. If you have less than 100 full-time employees in 2020, all your employees are eligible for the ERC, therefore you can capture all of the wages paid to those employees as qualified wages. And as Marty mentioned earlier, that would be up to $10,000 of qualified wages per employee. If you have greater than 100 full-time employees in 2020, then you're only allowed to count those employees that you paid but were not able to provide services. And then the same thing goes for the 2021 rules, only now your threshold is less than or greater than 500 employees. So again, if you have less than 500 employees for 2021 wages that are paid, you can count all employees as qualified wages for the ERC. If you have greater than 500 full-time employees, again, you're going to have to identify only those employees that you paid that could not perform services. And for 2021, the other change in the rule here is that now you can count up to $10,000 per employee per quarter.
One of the questions that we've had come up in this particular fact pattern is for companies that have been involved in acquisitions and dispositions. We'll probably get into this too in a later slide, but I'll deal with it now a little bit, is some company maybe in 2021 who bought a company, say first quarter of 2021, will ask the question of like, how do I count my employees for purposes of 2019 if I didn't own the company? Essentially, you need to pretend like you did own the company back in 2019. You follow the history of the trade or business as if you owned it back then when you're doing, we'll call it a base amount calculation, really, what your base number of employees were in 2019 in your gross receipts as well. So for purposes of figuring out whether you're a large or small employer and you're doing these counts, which are very important and much more beneficial to companies that are smaller, acquisitions and dispositions do come into play, and there is a methodology in order to make that determination.
And one final point that I forgot to mention, when you're looking at these thresholds of 100 or 500 full-time employees, they are determined across the entire control group. So any entities in that group need to be counted in considering these thresholds. So I think that's going to lead right into the next slide on after this one, which is going to go into the control group.
Great.
Thanks, Ann. So the control group is the same control group we use for tax purposes with a 50%. So it's a parent subsidiary group if you own 50% of an entity, or a brother-sister entity. So the good news about the brother-sister, or good news about these calculations is that it only applies to trades or businesses. So you look through, if you have an investment fund, you look through that investment fund to the owners of the investment fund to make the calculation. Brother-sister corporations are the same 5 or fewer people owning 80%. So, and you apply both the parent sub and the brother-sister rules to sole proprietors, partnerships, S corps. The last bullet on this slide reminds us that management companies do need to get aggregated with the entity that they manage. This you often see in doctor groups where they have a separate management entity, but the management entity has to have as a principal function management services, and so many management companies don't have that as their principal function, particularly in the PE world. So with that, I'll turn it. I think that moves us to misconceptions.
All right,
Great.
So let's demystify some of these myths and misconceptions with our panel, particularly around, I think, some of the thoughts for smaller employers where their related parties are involved in management or employees. So let's address some of those topics.
Very well. Yes, and we will, because I think we have an entire slide with respect to some of the considerations and clarifications recently that have come out with respect to owners of companies, their family members, how much they own, and whether or not you can include them in the gross receipts book. We're going to say that for the next slide. So I'll go through some of the other things out here. And this has been this includes topics that have been clarified over the course of the last 9 months. All right, number one, PPP forgiveness. I would say for the first 6 months of this year, we were under the impression that at the moment PPP forgiveness became real and the PPP loan was forgiven. It was not only our thought, but also that of many other practitioners, that those PPP proceeds became gross receipts for purposes of the employee retention credit. Turns out the IRS actually provided a safe harbor there in August that allows companies not to include PPP forgiveness proceeds as gross receipts. And so that ended up being a pretty large benefit to some companies that were right on the edge, whether or not they had a 20% decline in any one of the quarters of 2021. That was a big deal, I thought. And so it may be a question that comes up, but we wanted to address that now. Here's another big one is, if I claim an ERC, is that income to me? Kind of, but from a timing perspective, what really happens is, say, for example, you got a 2020 employee retention credit. You, as an organization, specifically if you're a taxable organization, would have to reduce the amount of your deduction for wages by the amount of your credit. So despite the fact that you apply for a 2020 credit now, don't get that credit until maybe refunded to you until 2022. That's still a 2020 item with respect to reduction of deduction. And so to the extent you haven't filed you've already filed your tax return, which is likely, you would have to go back and do an amended return at some point to show a reduction in the deduction. And so it's sort of an income pickup then. For 2021, not an issue yet. No one's filing their tax returns yet, but it's something to keep in mind due to the fact that those credits can be as high as 28 grand per person. And so that's a large deduction that would have to be eliminated from a wage perspective. You're basically trading a deduction for a credit that's much more beneficial, but there is an interplay between income tax and payroll tax for this purpose. Another item that comes up is with respect to the research credit. It's one or the other. So to the extent you got an employee retention credit and someone's wage goes into that credit, you can't actually take an R&D credit as well for that amount that goes into the ERC. There are methodologies to make sure you're maximizing both, but it does require attention paid in the way that you calculate that. It's something to keep in mind. From a monetization perspective, Anne's going to talk about that in a little bit on one of our later slides. One of the myths is that if you're working with a PEO, can you still get the credit? You can. The logistics of getting the credit are a little bit different than if you're doing your own payroll tax, but Anne's going to talk about that as well. Here's another big thing: private equity. 9 times out of 10, we will talk to maybe a private equity group, especially one last year, that was under the assumption that all the portfolio companies owned by a fund would have to be aggregated together for purposes of determining the employee counts and determining the gross receipts. 9 times out of 10, as I was referring to, probably not actually. If you really look at a strict reading of the aggregation rules, we're generally of the opinion, and we will look specifically at every organization and the ownership, but a fund ownership funds are generally not treated as trades or businesses, but rather passive investment entities. And as a result, the aggregation is broken. We're still following the aggregation rules, but under those rules, we can often get to the position that each portfolio company and potentially its subsidiaries are independently treated as taxpayers or as employers for purposes of employee retention credit. So there's a lot more benefit to be had than initially thought of. And it's not only Terry Bekaert that has this opinion. I've worked with some other firms, law firms and accounting firms, that have come to the same conclusion. Law firms, to the extent you didn't have the requisite declines in gross receipts, one area of, I don't know if it's confusion, but I would say illumination to some of the law firms is that due to court closures, they can take the position that that is a closure, a partial shutdown of their business due to the fact that, especially if they're in litigation, are practicing before the courts. And during the time the courts were closed or essentially slowed down due to government orders, there's a position there that to the extent it's having a material impact on the business, that they are qualified for purposes of the employee retention credit under the government mandate test. Tax exempt entities, here's another point. Absolutely, they're employers of people. This credit is intended to benefit companies that are keeping people on the payroll, whether you're a tax exempt entity or a taxable entity. Tax exempts still qualify. Government contractors as well, although there's some analysis that goes into whether or not those credits are something that might have to be given back to the government, but don't count yourself out if you're a government contractor as well. I would say so. Those are some of the topics of high interest as we've gone through this. And why don't we move to the next slide? And I think Deb can talk a bit about some of the myths around related parties.
So before we go there, Marty, we had some questions about what about suppliers? And I think maybe we want to go back to the government mandate test and talk about how suppliers specifically.
Absolutely. Thank you.
Was in the question.
That's a great question. Okay, so to the extent a company doesn't have a direct mandate on themselves, and they're not subject, and they don't have the requisite gross receipts to clients, but they have a supplier in their supply chain that has a government mandate on that supplier that is therefore then affecting the supply chain and affecting our company with whom we're working, that is enough to treat a company as being affected directly by the government mandates. So supply chain disruptions are something to consider. They're very important. We work with a lot of companies who have had them. The challenge there is to identify the specific government mandate on the supplier. It's not just any supply chain disruption. It has to be due to government mandates. So for example, I work with some companies in Texas that were indicating, hey, by the way, we had that terrible freezing and the supply chain was slowed down. Unfortunately, not a government mandate. That is an area of, even if you're an essential business and you have a supply chain disruption, that is something you can consider. Deb, I'll throw it to you if there's anything else you want to add there. All right.
Okay, so let's move on to the related parties, because you can't claim a credit for related parties. And I think we've had some confusion about this, because if you look at the definition of related parties on this slide, you will see that a spouse is not a related party. And that threw everyone into a tizzy as to, oh, does that mean spouses' wages don't get included? Well, the IRS gave us guidance on this in Notice 2021-49. And the key to understanding that notice or that guidance is that we're looking for related parties, which are the people listed on the top of the slide, but in determining that, you have to apply the constructive ownership rules. And the constructive ownership rules means that I am deemed to own whatever my brother, sister, spouse, ancestor, or lineal descendant owns. So in that way, by applying the constructive ownership rules, the IRS has gotten to the point where a spouse would end up being a related party to an owner of a corporation. The interesting thing that came about is highlighted on the next slide. These slides are a little dense because I wanted to put all the rules on them, but and I wanted to give a few examples. But what's interesting is that the way the rules interplay, if you have a majority owner of a corporation and the majority owner and the majority owner's spouse do not have any brother, sister, child, or parents that are currently living, then that majority owner is not a related party, and you can claim the credit for that. That you've got to understand, though, that it's very rare that you'd have somebody who had absolutely no family, brother, sister, or parents or children living. So I don't want to go through the examples because they're kind of confusing, and but I did want to put them in the slides so you can look at them later on. And if you have any questions, feel free to reach out. But the key,
I would just say high levels. Yeah,
parties is what you want to focus on.
Absolutely. Like Deb, key high level is wages paid to owners of the company or family members of the owner definitely require a second look, just to make sure that you can actually bring them in. That's where we're focused on. So that's something that we'll scope up. All right. The good news for PPP recipients, I've alluded to this, but there is still so much confusion on it. I'm just going to say it again. If you got PPP, you can still claim ERC. The methodology here, if we think about it just simply, is that PPP for most recipients with respect to their forgiveness application is computed over a 24-week, what's referred to as a covered period. Specifically, that during that time period, the wages paid to employees is generally at least double what the PPP amount is during that covered period, potentially even more. As a result, there is most of the time a layer of wage that is not funded by PPP, and as a result can be ERC eligible. Additionally, to the extent a taxpayer or employer still has the opportunity to apply for forgiveness in 2021, if they can, we'll call it, maximize the amount of non-wage expenses that go into the forgiveness application up to 40% of the total PPP received, that will reduce the amount of PPP funded wages and therefore increase the amount of ERC eligible wages in the pool. Again, one of the things that I believe the IRS will be looking for when these ERCs are audited is the fact pattern of a company that received PPP and didn't adequately document that the employee retention credit wages were not funded by that PPP. That's where we are very focused for our clients to make sure that that is adequately documented, and also making sure that they can maximize those credits as well. So that's the good news for PPP recipients. Without a doubt, there's probably an ERC for you. And there's some flexibility with respect to how the work papers are pulled together for purposes of documenting that ERC wages are not funded by PPP. Anything else, Ann or Deb?
Marty, can you comment on shuttered venue and restaurant revitalization grants as well?
I can somewhat, and I think Deb might even be better to do that for me as well. But I think with respect to the PPP, well, there's a couple issues there. One is, are they gross receipts for purposes of the employee retention credit? I think generally speaking, they're not. On this particular point, though, you can't double dip on that either. And so I would say that PPP is a much better benefit than ERC. Shuttered venue is a better benefit than ERC. Restaurant revitalization is a better benefit than ERC. Why? Because it's 100% covered, and it's money that's intended to help the business go. What you do is you maximize those and then figure out what is left over for purposes of ERC, which is either a 50%, 50 cents on the dollar or 70 cents on the dollar benefit. But nothing should be done in a vacuum. And so there's a lot of interplay among these things. But the most important thing is go for the PPP forgiveness, go for the restaurant revitalization. Don't not take advantage of those because you want to get an ERC later. ERC is not as good of a benefit as those. But as you're doing forgiveness for PPP, try to think about non-wage expenses that can go into that. Same thing for restaurant revitalization fund, all of it, shuttered venue as well. So that it does require, it will be to any employer and taxpayer's benefit to make sure that these things are looked at either by them or with their service provider so that they can get the maximum benefit possible. These all have different time periods, some of which overlap others, some do not. And so there's a lot of moving pieces there, but I think most companies can get some benefit from all of them.
Okay, well, let's jump into how to apply for the credit. So we've mentioned earlier, this is a refundable payroll tax credit, which means it's claimed on a payroll tax return, and payroll tax returns are filed quarterly. So I think the thing to keep in mind here is that the IRS has released a number of new 941s over this last year, 941Xs as well. Just make sure you're using the most recent version of the forms. The July edition is the most recent 941X. And for the 941, there is a June 2021 version that's the most recent as well. And the reason why it's important to use the most recent version is as the law has changed over the last year, this latest version is a lot thicker than the prior versions. The 941X is now 5 pages long. It also includes 5 different new worksheets that were previously not there. So the ideal situation is to claim the credit on the originally filed return for any quarters prospectively. So we're right now have closed out the third quarter of 2021, and that return is due to the IRS by October 31st. That ideal situation would be to get the credit on that originally filed return with your payroll provider. And it would go on lines 11C, 13D, and 21 and 22 of that tax form. If you cannot get that on the originally filed return, a lot of times that's dictated by your payroll provider and their deadlines, then you can always file a Form 941X to claim these credits as well. And again, I think you just have to be very careful in making sure that now you include the ERC on the particular worksheet, either 2 or 4, because now the IRS has split the 2 credits between ERC before April 1st and ERCs after June 30th. So again, just pay attention to those details, and if you have any questions, I'm happy to help there. And the ERC also has, on the payroll tax return, interplays with some of the other types of credits that come into play on a payroll tax return as well, particularly any of the FFCRA credits, which are your sick and family medical leave credits. There's a new COBRA credit in 2021 that also interplays with the ERC. So the key here is on the 941 is to prepare the worksheets first. The worksheets dictate how the ERC amounts go on to the 941 and or the 941X. The other change that I think is particularly important to mention is that for 2020 and the first 2 quarters of 2021, the employee retention credit offsets the employer portion of Social Security tax. Now that law changed beginning with the 3rd quarter of 2021, where now the ERC offsets only the employer portion of Medicare taxes. So again, there's some variances in the forms depending upon how what quarters you're taking the credit for. But again, happy to help and answer any questions there as well. So what's the truth about refunds? You know, the main question we get here is how long is it going to take for us to get our money back? Right now, we're seeing a difference between companies that are filing electronically and those that are filing via paper. So for 2020 ERC credits, it's almost everyone is having to file those on paper. So those are taking anywhere from 8 to 10 months to get processed. We are just now seeing companies beginning to receive those refunds, and those would be companies that filed early on at the beginning of 2021 for those credits. So it's a waiting game for anyone that files a paper 941X. Again, if you can get an ERC credit on an electronically filed Form 941, the processing time goes down anywhere from 1 to 3 months. And we're seeing some quick turnaround with the issuance of the checks directly from the IRS in that fashion. Now, so there's 2 ways to get your money back. You can either mark on the 941 or the 941X that you want the IRS to send you a check, or you can request a credit carry forward into the current quarter. So if you filed an ERC for the 2nd quarter of 2021, you can actually apply any of the overpayment from that return onto your 3rd quarter 2021 return. And that will also accelerate or help you monetize the receipt of that cash as well, rather than filing a 941X via paper and it taking 8 to 10 months.
All right. So right here, it's called Snapshot of a Successful ERC Project, but I'll just call it really like what our approach is. And to the extent, I'll just put it this way. A lot of companies still haven't thought about it. It's surprising to me, but it's not surprising because it's been a tumultuous 2 years. And so with the PPP program being so prevalent and so many subsidies and benefits available, ERC probably makes sense as the last thing somebody would look at, considering they changed the rules so many times going forward. With that said, to the extent anybody has any question about anything ERC related, we're happy to scope it out for them and have a discussion about what the facts are, what their particular narrative was with respect to potentially being affected by government mandates, analysis of what their gross receipts are, both individually and on a controlled group basis, and a scoping of what the potential benefits would be. Ultimately, in the end, a successful project for us looks like documentation with respect to eligible employer status, we generally have a technical memorandum indicating that we are more likely than not at the conclusion that a company does qualify for the employee retention credit. If it's a government mandate test, some indication, not some indication, actually a detailed indication of what the specific mandates are, how long they affected the company, and how long they lasted in duration. Additionally, if it's a gross receipts test, a quantification of what the gross receipts are in 2019 and those respective quarters of 2020 and 2021. A calculation of the employee retention credit with the specific offset for amounts received for PPP shown in the work papers as well. Also, and probably most important to many companies, is the prepared Form 941X's or the formatted amounts to provide to the payroll provider or the PEO working with the company in order to get those credits reported timely, or potentially on amended returns as well for the PEOs. But that's a successful project. I think it's important specifically for companies that have any questions about that interplay between PPP, Restaurant Revitalization Fund, Shuttered Venue, and ERC, and whether or not there was a mandate, and how long it lasted, and how many employees they have, that these things are going to be open to be examined for the next 5 years. Your statute of limitations for filing is shorter than your statute of limitations for how long they can look at the thing. They specifically extended the statute for how long they can look at the employee retention credit, which tells me they're going to look, because this is a pretty generous program. It's intended to benefit taxpayers and employers. It does, but I think it's to the benefit of companies to make sure that they're covering themselves and having that documented appropriately. I think we have one more slide after this, and then if there's any questions, we can get into that. From a data request perspective, this is just what do we request when we do these projects? You're going to look at your org charts so we can understand the control group relationships, and if there is or is not a controlled group. Also get a sense of what the acquisitions and dispositions were over time. The number of full-time employees. If you're near 100 or near 500, it is important to look very specifically at each month in 2019 and do that analysis. Keep in mind, full-time equivalent is different than full-time employee. There's no requirement to treat two full-time equivalents as one employee. If any person didn't work 30 hours on average in the month or 130 hours in the month in total, they're out of the count for that month. So some companies overcount. Gross receipts analysis, if you're on the edge, it definitely makes sense to take a look at that. And Deb's point earlier, there's no special rule. You don't change your method of accounting for gross receipts. Whatever you're reporting for tax purposes is the method that you use for purposes of gross receipts. Government mandates is probably worth a discussion before we start to look at what the mandates are specifically, but many companies just know anyway. One thing to consider, if a company is geographically diversified or in a large number of geographies, to the extent there's a mandate on the trade or business in one location but not another, technically speaking, the entire trade or business, irrespective of its location, qualifies. And so that analysis is important to make in determining whether or not the mandates are having a more than nominal impact on the business. PPP loan documents, obviously, forgiveness applications specifically, and then the wage data by employee, by pay period, by year. And some of that is some of the same data around the wages that we use for R&D. And so for those companies we're doing both R&D and ERC for, we can work to make the compensating adjustments to make sure we're not double counting there as well. So high level, ERC, interplay with R&D, interplay with PPP, interplay with shuttered venue, interplay with everything, but all these benefits are there, and don't sort of shortchange yourself by not looking at it specifically, because there's probably a lot of benefit there for you. And that's all I had here, but I don't know if there's any questions we want to go through.
So one of the questions we've had a lot is, what about the pending legislation and the fact that maybe there won't be any ERC for Q4? That legislation's been pending for a long time. It's the infrastructure bill. The later we go, nobody knows what's going to be in the legislation or if it will even pass. But the later we get towards the end of the year, the more likely they will not repeal it. The current law is there's a Q4 credit available.
I agree with you. I I find, yeah, it's passed the Senate, right? And the House hasn't voted on it yet, and the House is pairing it with the other human infrastructure as well. And that's earliest that's going to get looked at is October 27th. I doubt it'll get looked at that early. I think we're going to end up mid-November, early December before we have anything passed, but maybe I'm wrong. We'll see. If I were betting, I would bet Q4 stays in the law and that there's going to still be an employee retention credit through the end of the year. We're going to keep our eyes on it. Nobody can really claim it until they file a 941 for Q4. Maybe they could file a 7200 earlier, which we didn't really talk about much. But with that in mind, if I were betting, I would bet it stays in the law through Q4.
Let me address one question that's come up as well is people are asking about PEOs. If you utilize a PEO, what that means and the distinction there between a regular payroll provider is that if you're utilizing a PEO, they report your payroll and wages under their name and federal ID number to the IRS. So you don't have a separate 941. Instead, you are included on what's called a 941R that's reported by the PEO. So therefore, if you're trying to claim an ERC, you have to provide your ERC calculation or the employees that are eligible for the ERC to the PEO so that they can include that when they file an amended return for their own FEIN number and their own 941. So I think the takeaway if you utilize a PEO is there has to be some significant coordination with the PEO as to how are we going to get this credit included on your amended return, what's your deadlines, how are you going to get our refund back to us, and which is obviously the most important thing. You want your cash. So how's a PEO going to refund that money to you? Those are just some things to think about if you are utilizing a PEO.
Do we have any other questions to address? If not, do we have any final comments by the panel?
Deb, were there any more questions that you saw, or are we good?
It was an interesting one. We've gotten it a couple times. What about foreign affiliates? And I think we ought to talk both about the gross receipts test and about the employee counts.
Cool. I'll give my shorthand view, and then if you want to give a probably more detailed and nuanced and better explanation. But with respect to the gross receipts test, when we're talking about a organization that has foreign affiliates as part of the control group, and we're looking at gross receipts, we are looking at the gross receipts of the entire control group, both US receipts and foreign receipts, on a pseudo-consolidated basis. So for these global groups, there is the requirement to look at the global gross receipt. From the employee count, think the opposite way. Do the way the employees are defined for this purpose, just look at the US employees. And so when we're making our counts of full-time employees in 2019, it's really just those US employees on the books that are basically subject to FICA. So that it's US for employee count, global for gross receipts.
So another question, qualified for the ERC based on gross receipts, do we, in Q1 and Q3, do we automatically qualify for Q2 and Q4? Yes.
Yes. So the way to think about that rule is the technical way it's written is that, for example, in Q3, you can use either your Q3 gross receipts in 2021 versus your Q3 gross receipts in 2019, or the prior quarter, Q2, which would be Q2 2019 versus Q2 2021. You get 2 bites of the apple every quarter, which means that if you qualify on your actual gross receipts in one quarter in 2021, you automatically get the next one as well. And so under that fact pattern, yes, that company would qualify for all 4 quarters. Cool.
And what about Ann, you want to talk about the deadline for submitting 941 X's?
So the statute of limitations on a 941 amended return is 3 years from the date of filing or the due date of the return. So no real major deadline that's upcoming right now for you claiming an ERC or filing an amended return for 20 or 21. So you have 3 years.
There are questions about where do I find government mandates and how could I see how they might apply?
Okay, well, I would say the following, and this is where I think we can be helpful. This isn't just a plug for our services, but I would say is we probably had so many discussions with so many companies. It'd be interesting to hear the story of how you were affected. The mandates are things that we have tracked in our own database. We can also do some additional searches to find out they are somewhat updated throughout the year. And there are even some new mandates that have come on the scene in 2021, specific to the restaurant industry, where the restaurants are being required by the government to check the vaccination status of a customer, which kind of can cut off half the potential customer base of a place coming in. Things like that, they're always changing. So where can you find them? You can do your Google searches, but I think you'd be better off to talk to somebody like us or one of your local practitioners, but I think probably us really, because we've had so many conversations with respect to what your personal story is with respect to how you were disrupted, and then you'll know whether or not you had to do something different last year. The question is, how long was the mandate in place and how long were you doing it due to the government requirement as opposed to just being voluntary? So it's a little art more than science answer, but we're happy to talk through anybody on that issue.
We have a question on healthcare expenses. You only include the employer portion for healthcare expenses as wages. That's because any employee portion that was paid with salary reduction is already included in gross wages, or not paid with salary reduction, was already included in gross wages.
And actually, a point, Deb, I want to address really quickly is there are a lot of companies that for a short period of time, even if they were larger, say they had 150 full-timers or 200 or 300, back in 2020, right when the pandemic hit and the mandates started to come into place, that when they didn't know what was going to happen 3 days down the road, 3 weeks down the road, 4 months down the road, there might have been a time where they actually paid individuals not to work. The individuals didn't have the work to do. They kept them at a full salary. And until they got PPP, maybe then they started to fund them with PPP. Some of them might have let them go and furloughed them. Those furlough expenses, or healthcare expenses after furlough, can count as amounts that go into the employee retention credit. Additionally, if you kept them on and they didn't have the work to do and they were being paid not to work, or basically paid not to provide services, as a statute would say, there's a potential to think about that as an amount that you should include in your employee retention credit. I'll just leave it at that. I don't want to push it too hard, but it is an area where some of the companies larger than 100 have overlooked it.
Well, and I want to highlight, if you're paying somebody PTO or vacation or sick leave, that is not payments for them not to work. Those are payments that they earned while they're working. They relate to the time they're rendering services.
Yep.
So you can't just go and look at PTO and vacation pay, because those are not payments not to work.
Agreed.
I don't see many more questions that we haven't already addressed.
All right.
So do we have any closing comments?
I think we're good.
Okay. Well, I want to say thank you to Marty and to Ann, the Deb today for their time with us in the presentation and the time they put into preparing for this presentation. Please feel free to contact any one of these folks if you have questions. I'm sure they'd be glad to try to help you. Cherry Bekaert has a wealth of resources on our website about the ERC. Please go to www.cbh.com for more information. And lastly, thanks for joining.
Thank you.
Thank you.